So in 2016, we've seen a very strong revenue performance, $6 billion, up 30% versus last year, largely driven by our gem consolidated sales. The gem sales were driven principally by a large increase in volume of carats sold versus 2015, slightly offset by a weaker index price, but in turn we did benefit from mix during the course of the year. The net impact of all of that is an EBITDA in 2016 of $1.4 billion, which is a very large 42% increase over last year. What are we seeing? I think it's largely a restocking of the midstream. We've seen broadly flat consumer demand on last year, and we saw a healthy sales season at the beginning of 2016, end of 2015, which helped. So at the beginning of 2016, building on the actions we had started to take in the fourth quarter of 2015, we recognized the need to adjust prices, recognizing market weakness. During the course of the rest of the year, we've seen some recovery in price, such that overall the index price is down around about 13% in 2016 versus 2015. Part of that has been offset by a stronger mix in the products sold, so our realized price, whilst down on 2015, is down around about 10% to $187 per carat. In 2016, we saw a very typical split between our H1 and H2 results. Weighted towards H1, typically around about 55-45 split over the course of the year. We would expect that to continue, reflecting the fact that we have larger sites in the first half of the year rather than in the second half of the year. So very strong profit performance in 2016 with EBITDA of $1.4 billion, up 42% versus 2015. The split of EBITDA across our business broadly in line with what we've seen historically, with around 70 to 75% coming from the upstream part of our business, around 25% coming from midstream. Downstream, where the focus is principally on developing demand for our goods, we invested over $120 million in marketing, and we saw a contribution from Element 6 that was impacted by the fact that their markets were weaker. Overall, looking at our profitability performance, we've seen the benefits of higher volume sold during the course of 2016, offset in part by weaker prices, but in particular strong cash cost management, with our average dollar per carat cost at $67 per carat, down 19% from last year and still down 8% after adjusting for portfolio changes, such as putting Snap Lake on care and maintenance. So overall, we've seen production at just over 27 million carats in 2016, which is down around about 5% versus last year. Remember, that was planned in response to the weaker market conditions as we came into 2016. At Botswana, we've seen roughly flat production, with Chouaneng up, offset partly by Arapa coming down, including putting Damshire on care and maintenance. At Namibia, we've seen a reduction in carats produced, again largely planned as a result of the Mafuta spending more time in port, but we did see some lower grades in the land operation. We've also seen lower volumes, around about 9% down, partly as a result of the sale of Kimberley, which was announced in 2015. But then also there were some impacts from community unrest and labour actions through the course of the year, partly offset by treating tailings in order to produce carats. In Canada, we've seen Snap Lake put on care and maintenance, which has had a very significant impact on the production volumes, again planned, but in turn we're starting to see GK ramp up and contribute to our overall production level. Coming into 2016, we had a very high level of stock, and we consciously made the decision at the end of 15 to start to reduce production, which we followed through in 2016. I would argue that our production levels in 2016 are below the long-run norm for our business. At the end of 2016, we reduced that stock quite significantly, down around $300 million. And to supply to demand, we do see a need to now start to increase production again, back to historic levels. It'll come, I think, largely from two sources. A ramp up of GK will start to deliver additional carats into the portfolio, and we'll see additional production out of BOTSWANA, with other smaller increases both at Venetia and in the marine business as a result of the Mafuta being more available through the course of the year. So overall, we expect production during the course of 2017 to be in the range of 31 to 33 million carats. The very positive thing we've been able to do in the business through 15, 16, and we intend to continue to do into 17 and onwards, is to invest in the future of our production and our business more generally. In particular, at Zhuaneng, we're seeing the delivery of the Cut 8 project, with first ore being mined this year. At Canada, we see the continued ramp up of the Gaucho Kuei project, the culmination of around about $900 million of spend to deliver a new mine in Canada. Within the marine business in Namibia, we're seeing the commissioning and sea trials for the SS Nyoma, which was around about $150 million project, being delivered ahead of budget and ahead of schedule. And then in Venetia, we've got the ongoing spend of in the Venetia Underground project, which is a long-term investment in the future of our South African business. Our portfolio benefits from a significant diversity and range of the product we're able to deliver to our customers, ranging from lower value goods coming out of Canada through to very, very high value goods that come out of our Namibian business. Of course, costs of mining range just as broadly across the entirety of our portfolio, but what's really important is the margins that we deliver in our producing countries. And in addition to that, the value we're able to add to that product through the midstream activity that we undertake, which includes delivering for our customers consistency of quality and volume in order to be able to support their businesses, and understanding the dynamics of the market further downstream and helping develop that market to sustain the value of diamonds into the future. We've got good control over the cash costs within our business. An example is in element 6, where faced with significant headwinds in revenue as a result of ongoing weakness in industrial markets, principally in the oil and gas market, the management team's taken very proactive action to address their indirect cost base, bringing it down to largely offset the impact of lower revenues. Exploration remains a critical activity for the group and will continue to invest in exploration year on year. We spend around $35 million on exploration, focused principally in Botswana, South Africa and Canada.